All right, I want to thank everybody for joining us today. This option workshop is going to be on call ratio spread. So basically what we're going to do is take a long call spread and add a little bit of risk to it, and it's going to really create what they call as a short call ratio spread. And one thing I say about the beginning or at the beginning of all of these, you're going to get a recording of this a little bit afterwards. Please go back and watch it again, especially if you're new to this particular strategy or the way that I even set it up. It may seem very intuitive. Hey, yeah, you're just adding a little bit of risk to it, and that's all there is to it. Well, I have some rules that go around it, so some of these rules might miss you on the first time through, but the second time through, it'll really make it sink in, and you'll catch some of the nuances as well. So if you wait a month or so down the road, it's going to be like relearning it all over again. All right, so my name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical market analysis. I've been trading my own money for over 20 years. Actually, it's been about 25 years now. I started trading in college with some money I had earned, and was trying to get my psychology degree and decided to switch it over to finance after I started trading. And then upon graduating with a finance degree, I moved up to Chicago. Started out as one of those runners that's running around the pits underneath, handing people paper and running orders back and forth to different customers like JP Morgan and who all. And then I moved up into the pits and started trading from there. So I've been trading my own money for that entire time, basically. And so I'm not here to tell you I'm going to make you rich or make you a millionaire, but I am here to help you take control of your finances, manage your own risk, and most importantly, take control of your portfolio. If you're paying somebody to manage your portfolio, you guys, a lot of that money is kind of being lost through yield, or you're not getting as much yield as you probably could be. Anyway, I've traded in most markets throughout my career. I've traded everything from stocks, financial futures, commodity futures, and currencies, and options on all of these products in all market conditions. So I've seen a lot of it. I got to go over this disclaimer really quick, and it says any opinions, news, research, and analysis or other information provided by ProTrader Strategies and associate companies or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, I can't take into account your personal circumstances. That means like your risk parameters, what's in your portfolio. So what I'm talking about could actually be counterintuitive to what you're already doing and could exceed your risk parameters. So keep that in mind. And there's substantial possibility of loss while trading options. So please always have that in your thought process here. And the bottom line is, do your own homework. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. How do we get the recording? Rick's asking. It should be sent to you via email shortly after this video is over. It takes about an hour for it to render. It's like basically compress and switch it, flip it over, and then it should be sent out to you afterwards. All right, and hey, Trevor, shout out to Trevor. He's saying, wolf, wolf, wolf. All right, good enough. Speaking of that, you guys can follow me on Twitter at Wolfman's blog for snark and other general commentary about the markets. And you can follow ProTrader Strategies at ProTrader Strat. So there's a lot of good information sent out by ProTrader Strategies on different markets and some deals and stuff like that around that you can take advantage of. All right, so this is a great strategy to use with a bullish market assumption. One thing to keep in mind, we want it to go to a certain level and not really exceed it. Whereas like the regular long call spread, we don't care if it blows through the top of our short call because we're long that deep in the money call at that point, so we don't really care. We have no more risk after it goes past that. on this particular strategy, we're going to have risk above that short call. But we're going to try and create it where there is absolutely no risk to the downside, whereas with the long call spread, we have risk to the downside if we're wrong or if there's a market correction. So we're going to try and make it where it goes down, we can at least maybe even collect a little bit of credit or at least do this strategy for no money at all. All right, so other names for the ratio call spread is a 2-by-1 call spread or a 1-by-2, depending on how you look at it, and a front ratio spread. It's a neutral to bullish assumption. It being neutral only if you're being able to collect a credit. You know, if you're able to collect a credit, you really don't care if it just kind of sits there because you're going to get to keep that credit. And if it goes down, you'll be able to keep that credit. So, but bullish in the sense that because it is a call spread and it is really designed kind of like a long call spread, and we're financing it with an extra short call, that it is still bullish. Then this front ratio call spread, we're basically buying one just out of the money or just out of the money call and then selling two further out of the money calls. We could be buying one that is just right there at the money. We need really high implied volatility in order to be able to buy that just at the money call and finance it with a little bit further out, because I like to start selling this strategy, these calls that I'm getting short, at about 1 standard deviation move away. So we're going to be looking at that on the platform and how to build that out. We're basically looking for like a 16 delta, because only 16% of the time are we going to see that short call finish in the money. So we're going to try and take advantage of the probabilities of that not happening, and in order to do that, we need a lot of implied volatility. So picking the right strikes with this, I just kind of mentioned that. Picking the right strikes, I like to pick the 16 delta to start that. This is where we're going to be starting to sell this strategy. Trevor's asking, when do you buy the at the money call? You know, usually if you're a little less bullish, I guess, if you will, and you're looking for the market to kind of settle down, because we've had high implied volatility, means that, you know, there's a lot of movement expected. But if you think it's gone to, you know, Trevor, I think you said you were watching the, or Shady Tree was watching the market profile session. So like if there was high implied volatility and the underlying went right to the point of control, you would expect that it's going to settle down right there. So if it had high implied volatility and it was right there at that level, then that might be a situation where I do the at the money call to get long, because I would expect it to kind of bob around right around there for at least the next couple of weeks. So if you are more market neutral, then you would be picking the at the money call, because a lot of times when you're starting with that 16 delta short call, you need it to actually come up, just the underlying to come up a little bit in order to get inside of your long call, because it's going to be, you know, maybe like a 30 delta or something like that. Price or the IV to bob around? The price to bob around. We want the IV to come off. So what I'm saying is, like, if the market ran right to the point of control, but you thought maybe it'll move a little bit higher, then settle down right there in that area, then that's when we want price to kind of settle down, and we want IV to collapse in a sense. And if the market starts trending sideways, it will start to collapse rather precipitously. By picking the right strikes, so we want to make sure when we're building this thing out that we are able to do this for zero money out of pocket or a credit, to receive a credit, because there's no sense in doing this strategy for a debit if you're increasing your risk and you're still having to pay like a quarter or something like that for the strategy. There's a lot of other ways to skin a cat, and adding risk to a long call to pay a debit doesn't really make sense from a risk-reward perspective. And picking the right duration. So we want to get into that 45-day, inside that 45 to 35 days to expiration, because we want that theta decay to happen as well. Not only do we want to see the volatility collapse, but we want theta decay to happen, because remember, that short call that is added into this strategy is going to be the one, that short call strike is actually going to be where we're going to end up making our money. So we want this to have that theta decay happen rather quickly with volatility collapse, so that all of the premiums start coming out of those. So in that, this is what I'm talking about. Inside that 45 days, we get like a 50% drop inside of 35 days. So we're going to try and take advantage of this move right in here and try and cover it, somewhere between 21 and 14 days to expiration. I don't like going inside of the 7 days to expiration if I can help it, but sometimes you have to. But at the end of the day, I want to kind of be out within this area here. And picking the right environment. Yeah, sometimes I do have a time stop as well. A lot of times I look at it as a percent, but sometimes I'm kind of like, what, I'm inside of 7 days, that I'm just going to get out for whatever profit I can there. Picking the right environment, I mentioned this a couple of times. We want high volatility or high vega, and we want to capture that theta. So we want that timing issue. That's part of the environment, is that timing issue as well. So we want high vega and theta decay. And picking the right underlying, I go through this all of the time, you guys. Picking the right underlying is imperative. Getting in and out of strategies with very little participation in that montage of the underlying, which is just basically the options chain, just a fancy word of saying it. But inside of there, we want a tight bid ask. Any stock that's under $100, we want that bid ask to be about 10 cents wide. Anything over that, if you're looking at like Priceline or any of those stocks that are above $100 to like thousands of dollars, you want to take that where the underlying is trading, move that decimal place 3 ticks to the left, and that's how much you should be paying. So if it's a $1,500 stock, you move it 3 ticks to the left, the bid ask should be inside of, ballparking $1.50 between the bid and the ask. $300 stock, 3 ticks to the left, it's 30 cents. So keep it pretty tight, when it's a $1,500 stock, 5-10 cents leeway is okay as well. Is this a good strategy after earnings or other conditions? Could you use this strategy? You could take advantage of this strategy after earnings if you thought, hey, the market moved and I think it's going to stay here, or maybe just kind of trickle up, then yeah, you could do that. Or maybe the market kind of gapped up and you're thinking, hey, I'm going to be able to capture a lot of volatility today. Maybe the earnings were in the morning. Capture a lot of volatility, collapse today. The market could continue higher, and if you're able to collect a credit, you don't care if the market falls back down and even covers that gap. So, yeah, you could if the situation is right. So part of that environment on, picking the right environment, and at the end of the day, we want to make sure that we are collecting the credit and that there is expected to be volatility collapse. How about indexes and underlyings? So one thing to mention is with that high implied volatility percent, for underlyings, we want something that's above 50% IV, and for ETFs, something along those lines, indexes, above 30 is good for an ETF. That's a pretty high implied volatility for an ETF. If it's, XRT is one of the examples I was looking at today. It was right at 30. And the reason why I go with a lower threshold for the ETFs is because it's a basket of goods. So those volatilities kind of level each other out. They kind of average each other out. So a high above 30 for an ETF is pretty good because there's so many different underlying. Some of them won't have very much implied volatility, and some of them will have some really high implied volatility. So it will work that way. That answer your question? So I do use this with ETFs. As a matter of fact, I was looking at XRT today. All right, and then knowing the exit strategy. We got to know our exit strategy with this, and because it is, it's a pretty high risk strategy, and the problem with this strategy, one of the downstrokes with this strategy is if we're directionally right and the market actually rallies up to our short call or just shy of that with, say 20 some odd days to go, it's going to hurt a little bit. So anytime the market is kind of rallying up through and we're kind of getting our directionality and we see this theta decay happening, sure, and volatility, more important, start to collapse, we're going to look to cover this strategy at about like 25% to 50% our max profit potential. I'll go over the max profit potential here in just a second. But so we want to only try and get about 25 to 50% of it. One of the beauties with this strategy, though, is that if we set this up correctly, it's going to really increase our probability of profit and our return on capital. So, it's nice in the sense that it has a higher probability of profit and a higher return on capital than you would have with a regular long call spread, in a sense, is what I'm saying. But on the flip side of that, everything that's good has something bad. Well, we're going to have a higher margin requirement for this because we have a naked call. And there is a way to make this IRA appropriate, and basically the way I see it is if you're able to collect a decent credit for this strategy is to go out and buy a way out of the money call for like a nickel. That just kind of gets you through the red tape, if you will. It's not going to really decrease your risk on this. It just kind of makes it compliant, if you will. But keep it in mind, you are not really lowering your overall risk if you just go out there and buy a far out of the money call to kind of define that risk. You haven't really defined anything because the likelihood that it gets up there to that call, hopefully we would be out by then. And the other thing is I say with knowing your exit strategy, if we're losing on this trade, we're going to be looking to get out like 2 times of what our max potential loss would, or our max profit would be. So if you see what your know what your max profit is, multiply that by 2, and that would be really the point where you really pull the ripcord on that, if not sooner. All right, so our max profit on this is basically the width of the strikes plus the credit received. If you don't receive a credit, obviously that's 0 in that part of the equation. But the short strike minus the long strike plus the net credit received is your max profit. So in this, if it was like a $10 wide spread, or it's never going to be $10 wide, let's just say it's $5 wide, the width of those long and short is $5, and we collected, let's say, 35 cents, we can have a max profit potential of $5.35. So keep that in mind. That's another important reason to get that credit, because if you're doing it for a debit, you're going to have to subtract that out, and there's no sense in doing this strategy if you have to do it for a debit. You might as well do a long call spread or just a naked short call. So weigh those benefits and make sure that it's set up properly, because one of the few things we can do to be successful in options trading, and the most important thing to do to be successful in options trading, is follow your rules, especially the ones that I've come up with, and stick to those make sure you set it up properly at the onset, because that's the biggest management of all, is setting yourself up for success when implementing this strategy. Now, our max loss is infinite, so keep that in mind. It can continue to go up through our short strike and go forever. Is that likely in the next 45 days? Probably not, but you have to keep that risk in mind, that it can continue to go. And even if you bought that deep out of the money call to make it IRA appropriate, you guys, it is going to feel infinite. It is going to be more than what you're really willing to lose on a strategy. So make sure when you're doing this that even if you set it up for an IRA appropriate, buying that nickel out of the money, I mean, the probability of that nickel long call that you're defining the risk with is probably going to be like a 1% probability that it gets there anyway. So it's going to really feel infinite by the time it gets there, and hopefully you will be out for sure. If you're following the rule of 2 times the max profit to get out, then you will have been out well before that long call is breached to the upside. And the break even is going to be the short strike plus the max profit, because remember, we're going to make money all the way from the long call to the short call, but once it gets outside that short call, we're going to start losing money basically because of the extra short call. So, but we do get the benefit of adding in the max profit plus that credit of in my first example, like 35 cents, I think I said. So the short call plus the $5, because remember, we make the $5 as it rallies up to the short call. That's all profit plus that credit received. So you know, if we did this as a 40-45 long call spread with the extra short 45 call, that $5 is ours plus the 35 cents that we got to keep at the onset. So, you know, your break even is going to basically be $50.35 on that underlying string there. So it does give you a little wiggle room to the upside. All right. So anybody else have any real quick questions before I pull up the platform? All right, let's get it on. Was trying to look at GDX. GDX has been moving down, and thought that we were going to get some implied, or GDXJ, actually GDXJ is the junior gold miners. They have a tendency to carry a little bit more volatility, but never happened, obviously. So this is usually where I throw it out to you guys to give me some example, or give me some stocks that you guys like to trade, and I'll go through it. I think that we all will learn a little bit better, a little bit faster, because then I can show you the steps of this process as I go through them when we're pulling these up. All right, Luke's got first one up. He's got XLE. So we can look at XLE. It's going to be tough to find high implied volatility for just about anything. So we don't want the 98 days to go. It's got a 0, and as a matter of fact, if you look at this, like look, I was amazed today when I was going through this how many stocks have, you know, the 52-week low in IV percent. It's really making it difficult for anybody to make money in this kind of environment, actually. You know, even if you like to do debit spreads, the markets aren't moving very much at all, really, to make any money. They're kind of just choppy. So, you know, in that, so XLE, I'll just show you XLE. So it's actually settled down right here, but it's got low implied volatility. It's so low that our risks of it increasing grow every day because it's so low. It's like it can't, I mean, it can continue to do it, but the probabilities are there's going to be some volatility creeping into the market. Yeah, I know. Some of you guys are saying, well, you've been saying that for about 6 months, Wolfman. Well, believe me, I'm crossing my fingers now almost, but it's got to come back. So anyway, it's just too low to really risk that. You know, if you thought it was going to kind of stay here, it would be one thing, but without implied volatility, see, we're looking at a 50-cent range in order to get that credit. Maybe a little bit more. We'd probably go, what is that? From, if we went to, we wouldn't be able to go to the 16 delta, but necessarily if we were doing the at the money. So we can start at the 73 and a half. That's as close to the 16 delta as we can. So we're going to need to at least collect, I'm just going to do it as a double to get started, at least collect 50 cents for it. So we get a 12-cent credit for it, but you know, that's a long way to go to be right to start this strategy out. You know, if you thought it was going to settle down and you were going to be able to beat the probabilities with doing something closer to the at the money, then, you know, like say for instance at the 71s, we're going to have to probably sell the 25 delta. So gives us a nickel credit. So, you know, the probability of this 71 call being in the money at expiration is only about a 39% probability, which is pretty low. So that's why you stay away from it, for one, when there's low implied volatility, because when there's high implied volatility, these premiums get pumped up, so you can get further away from the market on the ones you're selling than when there's almost no volatility. And your, you know, strikes can be a lot wider, which allows you to have a lot more room to be right and or wrong, if you will. So you have a lot less room to be wrong. So that's why it's hard to set it up with something like this. So I would go with a completely different strategy on something like that, just because the risks of it moving outside when you get really tight are starting to mount a little bit there. Is this IRA friendly? Trevor, for instance, when I was talking about to make it IRA friendly, and if you got this 5-cent credit, you know, you're going to need to go out and buy a call for a nickel, you know, or something like that, just to make it IRA appropriate. It's not going to limit your risk whatsoever. If you get out here buying this one to make it IRA appropriate, then that makes it IRA appropriate. It becomes a broken wing butterfly. But I mean, that's exactly what it is a broken wing butterfly at that point, but that does make it IRA appropriate. It's not the way I taught how to set up a butterfly, but that does create that broken wing butterfly. But you would not, by the time it got to here, you were going to be well over 2 times the max profit potential on something like that. But having said that, our break even without that, you know, I guess with the 81s in there, we can figure out our break even. It's the width of these two, which is $1.50 plus that 4-cent credit, and that would make it at when it's trading 74.05. So you do have a little bit of room to the upside if we're looking at this. You know, you have a little bit of room to the upside to make that money, but the probabilities are going to be against you on just getting inside of your strategy there, which is fine because you collected a credit, you have nothing really to lose, so that's not too bad. So when you set this strategy up, which deltas are you looking at for the lower and the higher strikes typically? When I'm typically looking at setting it up to be short the 16 delta strike. That's where I'd like to set this strategy up and collect a credit for it, because, you know, then I can go down here and is this the one I set it up with? 1 cent debit. So I'd probably have to pick the 2.5 strike. Because I'd like to get at least a decent credit. So, you know, you got $1 wide in there. So if it never rallied up there, and if you're collecting a credit, if you're collecting a debit, never ever do it, because probabilities are against you that the market's going to rally up to that point anyway. But the other aspect of it is, if it doesn't make it up there, you could keep that credit. So, but it will hurt you if volatility expands, which is why I would like to stay away from something with such low implied volatility. Would you profit change when you convert to a broken wing butterfly? Yes, your profit potential does convert when you go to the broken wing butterfly, because you got to pay money for that long call that's deep, or way out of the money, I should say. But you would still be able to collect the credit you received at the onset, and if it did rally up, your break even would be basically the same as well. It'd be that smaller original long call spread width plus the credit you received, and add that to your short calls. That would be your break even to the upside. Okay. All right. So yeah, a lot of people are blowing me up with questions here. So Luke, we got you. Amaro is asking about Nike. Let's check out Nike. Also, I don't like to really do this strategy around earnings, just because I don't like the possibility it would blow through my short strike. So I've just never used it around earnings, to be quite honest. It's not to say that it wouldn't work, because the probabilities are that if it was around an earnings move, then that 16 delta strike still has a very low probability of being breached. It's going to be outside the expected market maker move, but I like to set up different strategies for that. But maybe I should look into looking into that. All right, so Nike does have an IV percent. I don't know how this didn't come up on my radar, but we got a high IV percent. Is it because it has earnings coming out? Does anybody know when Nike's earnings coming out? Yeah, it's coming out like right at the beginning of the next month. 3/21. Oh, it's 3/21. So right in here is where Nike's earnings are. So I probably wouldn't do this around Nike's earnings. But, you know, follow me on Twitter. I may actually just try this out once or twice to see how it works out, because if Nike doesn't come out with good earnings, then that market tanks. I get to keep that credit, and if it rallies up to at least where I'm outside of the market maker move, then I might give it a shot. So blast me on Twitter. Remind me to try that out. I'll try that out before you guys do on earnings. But Nike has earnings, so I wouldn't want to set this up this far in advance of earnings if I was even going to do it for an earnings trade, because IB is going to likely expand on me while we head into that binary event. So I want to try and capture as much as I can of it. You know, in a perfect world, we want to be putting this strategy on as IB is like turning over, you know, in a situation of, you know, of course it does it every time on the earnings, but you want to have IB just start coming off. And, you know, like somebody was asking, you know, can you do this after earnings? Like, you could have done this after earnings and gotten all of that IB collapse. You'd have to have worried about it breaching your short call spread, but I'm thinking that as, you know, steady as a move as that was, you probably would have been up in this way anyway, so you probably would have been able to get out rather quickly. All right, so I'll get to you on Tesla. So volatility increase hurts this strategy, yes. So we did SLV for Ted, and Ted, I'll get your SLAB, Silicon Labs. What are the options like in there? So it's got relatively low implied volatility, as does everything else. But I'm betting that it has lower than 50% IV. So it's a $70 stock. So this is an example of what I was talking about. It's a $70 stock. So if we move this 3 ticks to the left, it should be like 7 cents wide we should be looking at. This has got 45-cent wide strikes. So I probably, the reason why I haven't didn't really know what this stock was is because, I mean, I've heard of Silicon Labs, don't get me wrong, but didn't really recognize the ticker symbol right away because I've written it off a long time ago because it just doesn't have the participation in the options montage. That's just way too much of an edge to give up for me. You know, that's me. I just don't like when there's just no open interest in volume, because when things start getting busy, then people flee out of this. You know, there's only 123 open interest in this contract. So to get that counterparty that already has open interest in there, or somebody that wants to add open interest, is pretty difficult. You know, it did have 10 contracts today, but that's the entire montage. So I would stay away from this. Who was asking about this? Ted. All right, so you know what I mean? That's what the real good example of what I was talking about. It costs so much to get in and get out, and if it starts getting volatile and something starts really moving, it's going to be really difficult to get out, especially if they start going in the money and stuff like that. Okay? Or if it starts going bad on you, you're going to have to give up a lot of edge to get out. So Netflix. And I've got a position on their long call spread from one of the webinars. So we could set this up with looking at the 33, so it's still pretty low. Looking at the chart, you know, it's in an upward pattern, even though it's kind of broken down and moved sideways. So if you weren't worried about their earnings, which is probably just around the corner, it's probably going to fall in, it's probably going to fall somewhere in this area. Oh yeah, it is. So in the options montage we're looking at is right in here, and they're coming in on like the 18th, I think, for theirs. So I'd wait for volatility to really expand for something like that, or you thought it was going to start collapsing. And then FDX, and then I'll start. High implied volatility, but you can see right there they have earnings coming up, so that's why it's probably really close actually. Comes right at the beginning of that option montage on the 21st also, so probably going to stay away from that as well. All right, so I'm getting a bunch of people asking questions. Let me try and get some. Would your profit change when you? Oh yeah, you already answered that one. Which is your preferred vertical call strategy? The traditional vertical call spread, or this ratio call spread, and why? Well, I like to collect a credit on any kind of strategy, any strategy I do, Luke. So if there is the opportunity to collect credit, that's when I'm going to do it, because for one, you're taking on more risk, but when you take on more risk, you're increasing your probability of profit. And if you can increase your probability of profit, then to me that's worth the risk. So between the two, the long vertical call spread where I got to pay a debit, or the ratio call spread where I can collect a credit and still be wrong, then I'm going to do that all day long. Does that answer your question? That's a high-risk strategy for such little reward, the credit. Well, the idea is you're still bullish, right? So the credit is if you're wrong, if you're completely wrong. You know, like with the long call spread, if you're wrong, you stand to lose that entire debit. What we're doing here is if we're wrong directionally and the market goes down, or, we're at all-time highs, right? So a lot of people could be looking at, well, I think we can squeeze out a little bit more, or the market's going to go back up and test the highs and maybe settle down up there for a little bit, kind of really try and figure out if it's going to continue to go higher, But, the looming pullback possibility is there. Well, in that regard, then, you know, you're still getting the credit for being wrong, and there's something to be said for that, right? Wait, I was completely wrong and I still made money? Yeah, that's the way I look at it. Could use this to fix a long stock that I have, Valiant Pharmaceuticals. Well, Joel, if you are long Valiant, right, then I would, and it's a losing stock, then I would go in and sell calls against it. And I've done a webinar on that, covered call strategies. Do that, lower your basis. And that goes for anybody that has, I don't care if your stock's winning, you should still be selling calls against it. If it gets called away, wait for the pullback and buy in. I mean, as a matter of fact, it goes back to college. That's how I actually started trading. I started buying stocks when I was in college. And then this guy told me that was working at the discount brokerage place I was using. It was like, dude, why don't you just sell some calls against it? Because I was complaining. I was like, I bought IBM, I bought Walmart, and they do nothing but move sideways. I can't make any money on them. He was like, why don't you start selling calls against them? And I was like, you know what? I will. So, you know, that was a way to, you know, it's like getting an extra dividend. And if the market goes up and you get that stock called away, then, you know, you got called away. You wait for a pullback, you get back in if you want that part of your, you know, core portfolio. But sell calls, just collect, you know, 25 cents, you know, 35 cents every month basically, and lower your cost basis on that. And that way the market doesn't have to come back as far to make money. Anyway, off that soapbox. But check it out. Go to protraderstrategies.com and check out that. So here, let me go, since we're running a little bit on the edge. I'm going to go through a couple that I found that I thought would be, we did FedEx, didn't we? Did we look at FedEx? I think that was one of the ones that came up on my, oh, right. FedEx was an example. I was thinking if we didn't have earnings would be a great one. So I put all the ID percent over here on the side. I would suggest you guys too, so you know immediately without even, I mean, I'm like right now I'm not even looking at the stock. I don't even care. I'm just going over the side here and trying to find something that doesn't have an earnings in it. Qualcomm just had their earnings, I think, and I actually have open position in there, but those didn't really work out very well. I think I went down and had to start, I think I pulled up FedEx because it had, as an example, just to show you guys a good example, a similarly kind of good example. So we wouldn't do this necessarily because there's earnings in FedEx like right here. So, but assuming there wasn't earnings, we've got high implied volatility, and we wanted to do something in here. It's just, again, assuming there was no earnings to make a good example. We would look at something like, you know, you could look at these 195s if you thought it was just kind of trickle up and settle down. To me, if it breaks below this value area high, I have a feeling this market's going to just drop out of bed. But you can tell it's kind of been bobbing back around, so I would be looking at, well, here's the all-time high, or at least the 52-week high, right here at, you know, 200. So that is always going to act as a resistance to the upside. So, so I'm looking at the 200. So if I wanted to pick the at the monies, then I would, you know, buy one of these and then sell two of those. So we get the $5 on the upside, and then plus the credit we received of $1.47. So if this goes up the all-time highs and tests that, we get the $5, the $5 width plus the $1.47. So at 206.47 is where our break even is to the upside. So to me, that seems like a pretty good risk reward. if there wasn't earnings. So that's how we would set that up to look at it on the, oh, it's not going to give that to me as I guess I could have. Sorry guys, let me try to get this down to 2 so we can look at it on the Analyze tab to show you. So let's look at Analyze the trade, and then the FedEx. So which one is it? What did I say it was? $1.47. So it's gotten better since I was looking at it earlier today. So anyway, we'll look at this one then. So as you can see, anything to the downside, we get to keep that $1.47, but as soon as it gets up above that 206.47, I must not be on it right, 206.47 is where that number is, that's where we start losing money to the upside. So ultimately, if we can get it to nail right there on the short call at expiration, that's when we get that top amount, but I'm not going to hold this into the end of the day. So that's, you know, that's taking on more risk than what I'm willing to take. So if you've got a huge risk parameter and like that kind of risk, rolling the dice, then so be it. You know, the other, if it was up here just above your break even and you just kind of wanted to wait it out, you're willing to lose a little bit of money on that, then that's about the time that I would probably go into, you know, the last couple of days, or if it was, you know, down, way down in here or something like that, you know, a full standard deviation away to the other side, I might just like squeeze it out a little bit more. But at the end of the day, I like to clean those positions up and be done with them. So somebody else was asking Ulta, so let's look at Ulta and get rid of this so it doesn't come up next time I look. Ulta does have earnings coming up, I believe, or did they just have them? Okay, so they just had them. Big spike, so this is actually a pretty good example. I think their volatility is starting to come out of it though, so maybe we could take advantage of that. As the volatility has probably come out of it even since I looked at this. So it's really rallying, so you know, we could think, hey, this is going to continue to push higher. You know, their earnings, they already came out with their dividends. I don't know how well they beat their earnings offhand. So they beat them by about 12 cents, 11 cents. So, so we're going to be under the assumption volatility is going to continue to come out of Ulta, and the market is going to continue to rally. But if it falls out, if it comes back down and tests that, then we're not too worried. So I usually start looking at, so Ulta is you know, $300 stock, so we'd want it to be about 30 cents wide, or yeah, 30 cents wide. I can tell you Ulta is usually a pretty good market. I mean, you can tell they have a lot of volume and open interest, at least now. I guess they don't have very much open interest, but there's a lot of volume going on anyway. Ulta, I've traded Ulta a lot. Some of these stocks that get really high dollar, there's a lot of traders in the weeds. So, you know, that whole 30 cents thing, you know, you can kind of wiggle it a little bit. Ulta usually, I think, has even tighter markets than this, but it's on the outskirts of my comfort with the width of the bid ask. But I do know that there's usually a lot of people in here trading this stock. So I, you know, just from knowing that, I would be willing to do it. But it doesn't have that high IV anymore. It's not above 50. But for sake of argument, let's just kind of look at it, and we could look at it being the, let's say, the 295s. If we wanted to do the at the monies, you probably sell, can we sell 2 of these and still get her done? No, it's going to be a 75-cent debit. But, you know, with this wide bid ask, you know, it's something you could do is just go up and change this to 0 and make it work, right? You know, you don't have to enter it at the mid price. As a matter of fact, on something like this that's that wide, where it's $1 to the downside to get to the natural, you can almost figure it's $1 to the upside. So, you know, a quarter credit is the natural both offers, the offer, or sorry, both the bid and the offer of the opposing. So when you're buying, you'd be buying the bid, and when you're selling, you'd be selling the offer. And start a little bit higher and kind of work that out. But the other thing we could do is be looking at the delta and look for the 16 delta, which is right here. So on this, we'd be selling 2 of those and then buying, since we're getting about $1.15, we're probably going to be able to get about $1.45 or something here. So we could start it out at $1.45, so we're looking at paying $3 for it, so it's going to be this one. So the 305, you're getting a $1.15 credit, and at 300 and 305, I mean, you still have a long way to go to be right, but if it doesn't ever make it there and it goes back down, you know, you're golden. The other thing is $1.15 to the upside. So yeah, I don't know why that's. Is that right? Oh, there we go. That's why I had it locked. Sorry about that. 45 cents to the upside. So you still have a lot of room to the upside before you're right. You still get to keep that 45-cent credit. Do you turn on the delta column? Oh, can you turn on the delta column? Yeah, I think I did that. That was probably a little late for me to read. How this strategy reacts to increasing IV or a drop in IV? Well, an increase in IV, great question, is going to cause these premiums. You could see these premiums inflate. And when the premiums start to inflate, since we're short double these 305 calls, that's going to start to hurt rather quickly because volatility is expanding and we're short more than we're long. I mean, these are going to inflate, but they aren't going to keep up, or these are going to inflate, but they're not going to keep up with the pace of your being short these 305s. But contraction, these are going to, you know, since you're double these, you're going to collect twice the premium twice as fast in a sense. Does that make sense? Is this call ratio call spread strategy considered a high or low probability strategy? It is a high probability strategy if you collect a credit or do it for no out of pocket. It's a high probability trade. The reason being is it's because you're short those calls, and the probability of those short calls, and that's really where you're making your money, of going into the money is very low. It's a 16 delta that we're starting out with. Delta means that it has a 16% probability of finishing in the money at expiration. So that's pretty low, right? I mean, 84% of the time you're going to be right. Does that make sense? Does that answer your question? All right, good. Does anybody else have any other questions? So that's how we set it up. But the beauty in this, and it's been difficult, we're using Ulta with only a 32 delta as an example. XRT just went below 30, but you know, earlier today it was above 30, but it didn't really work out very well when I was setting up trying to set it up to get ready for this webinar. And you know, the idea, you know, if you can take anything away from this at all when you're doing this as a ratio spread is collect a credit. But when IV has really expanded for us, and it does work with the, you know, the stocks that are a little bit more pricey, if you will. You know, it's not going to work very well with like a $2 or $3 stock at all. And I would never do it with one of those because your risk to the upside is so much greater than your risk to the downside just in price. So it does work a little bit better with the stocks that are closer to around 100. But when there's higher implied volatility, if this had really high implied volatility, we might be able to do this strategy with the 300, 310 calls because there's so much more pumped into those premiums. So the ideal situation is have high implied volatility or contracting volatility in order to take advantage of the premiums from the short strike. Absolutely. But I'm only going to implement this with, above 50% or 50 IV%. So, but yeah, if you saw it right after earnings and you saw the market moved and decided, hey, I'm going to throw this on there, and that's within your risk parameters, then yeah, then if the market was rallying up, then for sure. Even if you got it where you did the at the monies and just a little bit out of the money where the market was going down and you were able to collect credit, then you are just banking on collecting that credit. But in that type of scenario, I'd probably be just selling a 16 delta call, and watching that collapse. But if you wanted to try and capture some upside potential, then that's when you would do the long call spread with that extra short call. Do I sell naked calls? If you're asking, do I ever sell naked calls? Yes. And as a matter of fact, in a sense, you are selling a naked call with this strategy. So keep that in mind as well. This is going into it with selling a naked call. But I do also do just naked calls and naked puts sometimes, depending on, what the situation is. Okay, so hey guys, this is the deal for joining us today. It is my options course. There's over 20 videos and big time sale, $36, and that's for participating in this. Basically, how to set up my options screen. You saw my side there where I have the IV% and several other things. I show you how to set it up just like that. I also show you how to set up the rest of my platform in a sense. Talk about how to measure delta, what your odds of winning trade. If you learned anything at all with like me talking about the delta and the probabilities, this goes more into detail. So like if you learn anything at all from this one video or this one webinar for $36, you're going to learn quite a bit. So like if you've enjoyed my webinar today, this is a great deal and you should take advantage of it for sure. How to measure time decay, which is going to be really important with strategy like this. How to trade options using gamma. That's a situation where we're trading in that shorter period of time, closer to expiration. So you can talk about how to trade gamma trade, if you will. How to set up how to trade using market profile, how to set up strategies around that using market profile. Little fun one, the history of options. That's a really good one. You guys should check that out. It started out, believe it or not, with a philosopher that got control of all of the olive presses and made millions of money. So I go into that. What are options if you're a really newer trader? Some of the options terminology, and protecting your portfolio with options. Now this is really important because I actually go into protecting against rising interest rates. We're in that kind of environment right now, you guys, where interest rates are going to go up. It's almost a done deal for the Fed to raise rates at the meeting here later on in March. If you have bonds or treasuries in your portfolio, and most people in like a 401k, IRAs have bonds or something like that in there. When interest rates go up, the value of those bonds goes down. Now you can hold it till expiration, with 30 some odd years, or 30 years, 27 years, whatever it is, and wait for par value. But at the end of the day, most people hold those bonds for like 7 years. But in that time, the value that you bought it at, say you bought it at par or 100. When interest rates go up, it's going to be worth like 95, and it's not going to be able to keep up with the increase in interest rates. So it's just going to get decimated. So how long do you have to watch all of these? You're kind of given these, and you can go in and check them off. Like you can say I've watched this one. There's like a little thing on there, and you can check it off as you watch them. So it's also nice that when you're looking at it, like, hey, did I watch that video? It gives you a way for checks and balances on the ones you've watched and the ones you've not. But even for the $36, this one video alone is going to save you guys tons of money, especially guys that have 401ks and stuff like that, and if you can trade your 401k for sure. And calculating the cost of options. So this is only like a few of them. Trading stock splits, everything. I go into how the markets usually react with stock splits. This link is in the chat window. So we've been communicating back and forth with the questions about the link is right there in the chat window. And if you're watching this on tape delay, the link is right here. You'll just have to pause the video and write it down. This is also the link for it here in red, so you can pause and write it down. But later webinars, I'm going to be drilling down on option components, how to trade options, when and where I find trades appropriate and or strategies appropriate. I want to thank you guys all for watching, and you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. So take advantage of this, guys, seriously. In this rising interest rate market, this one video alone is going to be worth that $36. If you got $100,000 in your portfolio and they increase interest rates by 25 basis points, you could see that value of that bond portfolio go down by 25% almost. So keep that in mind. So if you've enjoyed this, I strongly encourage you to take advantage of that. And these are all designed to produce consistent winners, through probabilities and everything else. So that's about all I got for you guys today. All right? So if you can't take that, take it easy.